BTQ Technologies Corp., trading on the NASDAQ under ticker BTQ, is currently sitting at 6.42 USD. That's a green candle, up 3.13% or about 20 cents, as we see here at 9:40 a.m. Eastern Time. But that simple 3.13% gain is actually masking the real intraday story, and it's a story of a fight. Looking at the day's data, the stock gapped up from its 6.23 previous close, opened at 6.45, and immediately spiked to a high of 6.67 right at the bell. Then, just as quickly, it was sold off, hitting a low of 6.37 before finding this current level at 6.42. This isn't a calm, steady climb. This is a classic gap up and fade, a move that suggests overnight optimism from retail traders or news chasers was met by a wall of supply, likely from institutions or early investors taking profits on that initial burst of enthusiasm. This 10-minute battle tells us more about the stock's character than the simple up 3% figure does. The general expectation for a stock like BTQ is straightforward, if a bit of a fantasy. Investors see Technologies Corp. And BTQ, and those who have done a little research see the term post-quantum cryptography. This immediately conjures images of a high-tech, futuristic company building unbreachable fortress-level security for the next century. The narrative is that quantum computers will one day break all current encryption, and a company like BTQ is creating the new keys to the kingdom. The expectation is that this 6.42 stock is a ground floor ticket, that its 52-week high of 16.00 is just the first peak on its way to a $1,000 valuation. People buy it thinking it's an asymmetric bet, a small investment that could become a life-changing windfall if they are right. The reality, however, is significantly more sober and infinitely more complex. The 9:40 a.m. chart, with its fade from 6.67, is the reality. The fact that the market summary shows no PE ratio, no dividend yield, and no market cap listed in this view is the reality. BTQ is not a company you can value using traditional metrics. It doesn't have profits, so a price-to-earnings ratio is meaningless. It doesn't return cash to shareholders, so dividends are non-existent. This is a pre-revenue or perhaps very early revenue research and development company. Its entire 6.42 valuation is not based on what it earns, but on what it might one day achieve. It is a bet on its intellectual property, the patents it holds, and the brains of the people it employs. The 52-week range, from a low of 4.94 to that high of 16.00, is a chasm. That 225% spread between the bottom and the top isn't fundamentals, it's pure, unadulterated sentiment. It shows a stock that is entirely disconnected from traditional valuation and instead trades on news, hype, and the broader risk appetite of the market. When tech is on, BTQ flies. When the market gets scared or when interest rates rise, a company that might be profitable in 2030 looks like a terrible place to park cash, and the stock gets crushed. This kind of speculative nature makes it a prime target for short sellers. The short thesis on a stock like BTQ is almost too easy to write. A short seller isn't necessarily saying the technology is fake. They are betting on a much simpler, more probable outcome, that the company will run out of money before its technology becomes commercially viable. They are betting that larger, Goliath-sized competitors, think Google, Microsoft, IBM, all of whom have massive quantum and cryptography research divisions, will develop their own solutions in-house, or that the government standardization process will select a competitor's algorithm, leaving BTQ with a brilliant solution that no one wants to buy. Short sellers would point to the company's 10Q filing, look at its cash on hand and its quarterly cash burn, and make a simple calculation. They're betting the company will have to do a secondary offering, selling millions of new shares at a discount to raise cash, which dilutes every existing shareholder and causes the stock price to drop. For any investor in this name, understanding the short side is not optional. It is essential. You need to know where to find this data. You can find the official short interest data published by FINRA twice a month. This will tell you the percentage of the company's float that is sold short. Is it a small 5% or a massive 25%, a large number confirms a heavily contested stock. But more important is the cost to borrow, which you can find on specialized platforms. This is the interest rate short sellers must pay to borrow the shares. If that rate is a normal 2 or 3%, it's not a big deal. But if that rate spikes to 20%, 50%, or even 100% annualized, it means the supply of lendable shares is tiny and shorters are desperate. This can be a tax on their position, making it painful to hold. You must also monitor the failure to deliver, or FTD data, which is published by the SEC. A high and persistent number of FTDs can suggest settlement issues or naked short selling, though it's a complex signal. What's your take on the rising short interest we've seen in many small-cap tech names? Do you see it as smart money identifying overvalued companies, or is it a coordinated attack to drive prices down? Let me know your thoughts in the comments. When you see a short report or high short interest, the wrong reaction is just to scream manipulation and short squeeze. The right reaction is to read the bear thesis, acknowledge their points. Does the company really have a high cash burn? Is a competitor's technology gaining traction? A responsible investor uses the short thesis as a tool to stress test their own bullishness. Sometimes a short squeeze does happen, but it's a low probability, high-risk gamble. It requires a catalyst to force the shorters to cover, and just wanting a squeeze to happen is not a catalyst. So what exactly does BTQ do? It's in the business of post-quantum cryptography, the entire world's digital security. Your bank account, your email, government secrets are protected by encryption that is easy for computers to solve one way, encrypting, and incredibly hard to solve the other way, decrypting without the key. The problem is that a fully functional, large-scale quantum computer is theoretically capable of solving the hard part very quickly, rendering all our current security useless. BTQ's business is to design, patent, and license new encryption algorithms that are secure against attacks from both today's computers and tomorrow's quantum computers. Their business model is not selling software to millions of users. It's big game hunting. They are trying to get their algorithms included in new government standards, like the one being run by the National Institute of Standards and Technology, NIST. They're trying to license their patent portfolio to massive defense contractors, cloud providers, and financial institutions. One single contract, one single licensing deal could be worth hundreds of millions of dollars and would instantly validate the company, sending the stock far past its 16.00 high. But that is the entire risk. Their fate may rest on the decision of a single committee at NIST. If NIST selects a competitor's algorithm as the new standard, BTQ's technology could become obsolete overnight. This is a binary risk. It's an all-or-nothing proposition. This is why looking at past performance, while useful for context, is not a predictor. The financial reports from last year or the year before will show what we already know: R&D expenses, administrative costs, and a net loss. The only number that truly matters in those old reports is the cash balance and the rate at which it's declining. That is the company's runway. How much time do they have left to land the plane before they run out of fuel? Looking forward, the future of BTQ is a story of catalysts and risks. The catalysts are clear: a positive announcement from NIST, a major partnership with a company like Lockheed Martin or Amazon Web Services, a new foundational patent being granted. Any of these would be transformative. The risks are equally clear. A competitor achieves a breakthrough first. NIST chooses a different standard. The company runs out of cash and is forced into a highly dilutive financing round that crushes the stock price back to its 4.94 low or worse. The macroeconomic environment is also a huge risk. As long as interest rates are high, the risk-free rate on a 10-year treasury competes directly with BTQ. An investor can get a guaranteed 4% or 5% from the government, or they can take a massive gamble on BTQ might be succeeding in 5 years. That's a tough sell, and it puts a natural cap on the stock price. On social media and forums, you'll see the HODL, or hold on for dear life crowd. They are focused on the technology's potential and see any price drop as a discount and any short seller as an enemy.
This passion is born from the expectation narrative, but it often ignores the reality narrative, the balance sheet, the dilution risk, the competition. This us versus them mentality between retail bulls and hedgy shorts can create a lot of noise, but it doesn't change the underlying fundamentals. I want you to tell me, what do you think is the single most likely catalyst that could legitimize BTQ? Comment below whether you think it's a government contract, a big tech partnership, or a major technological breakthrough. Ultimately, as we watch BTQ trade at 6.42, oscillating between its morning high and low, we are watching a microcosm of this entire battle. The expectation is that this is a 100x stock, a company that will secure the future of the internet. The reality is that it is a highly speculative, cash-burning R&D company in a high-stakes race